Hello folks, Steve Lentz here with Discover Options here at Option View Systems International. Welcome to this presentation of 3 different S&P 500 market timing reports for advanced options traders. Presented material today is for educational purposes only, should not be construed as personalized financial advice. Past results not necessarily indicative of future performance. This will be for Friday's close on September 14th, getting ready for Monday's open on the 17th. And before we get going, just want to remind you that this is brought to you by Discover Options. We are a one-on-one personal mentoring program firm for advanced options traders, or those aspiring to be advanced anyway. We take folks that are intermediate and beginner level and get them up to speed at an advanced level in as quick an approach as possible. We have great mentors that'll take you as far as you want to go. So give us a call or just shoot us an email. More about this later at the end. All 3 market timing reports look at the current market condition. We express this in 3 different dimensions: price action, trend, and the stochastics. In terms of price action, Thursday was an upswing day with higher highs and higher low, and then Friday was an outside bar with a higher high and lower low. Okay, that price action occurred in an uptrend where we are above the 50-day simple moving average. And then in terms of the stochastic, we are between 50 and 90 and in an uptrend where the 15-3 stochastic is above its 3-day %D. All 3 dimensions brought together make for a market condition that has occurred roughly 43 times since January of 2000. It's not too many, and that's because of the outside bar that you see there from Friday. That just has, that price action has not occurred that often in an uptrend where the stochastic is also in an uptrend like that. So, with that said, let's go to the Condor butterfly timing report. This answers the question, is now a good time to put on or initiate a butterfly campaign or a Condor campaign? So since January of 2000, we've had roughly 4,719 daily closes of the S&P 500. Now, of these, 65.1% have been favorable bars for selling options premium, where the actual 21 bar subsequent movement was less than what was being implied by the SIBO's skew adjusted VIX calculation. Okay, so roughly almost 2/3 of the time the S&P gives us a bar which turns out to be favorable for doing butterflies and condors. Now, as I said, we've had 43 occurrences of our current market condition. Of those 43, 69.7% of the bars have been similarly favorable for selling premium. That's more than the benchmark of 65.1, so we have a theoretical premium selling edge of roughly 4.6%. Roughly 4.6% on the positive side, a positive selling edge. Okay, now bear in mind that's only 43 signals in the past, okay, but it is what it is. We prefer to have that well over 100, of course, but it is a unique market condition, and it gives us at least a little bit something more than nothing. So there you have it. You have an edge given this information. Now, in terms of a bull put spread approach, where you're selling put options, say a standard deviation away, 30 days out, okay, that's kind of the premise of our bull put spread timing report. All right, so of the 4,719 daily closes of the S&P 500, 83.2% have been favorable bars for selling put premium in this fashion, where the actual 21 bar downside movement was less than the SIBO's skew adjusted VIX, which is implying a certain movement to the downside. Okay, so 83.2% of the time, the market has not moved down to that level. So if you sold puts standard deviation away 30 days out, 21 trading bars, okay, 83.2% of the time, on average, it would not have gotten hit. Okay, now the other 16.8% of the time, the market does move down and hit that certain point, 30 days out, standard deviation away, it hits that by then. So that's the benchmark. Now, of our 43 occurrences of our market condition, 76.7% of the bars have been similarly favorable for put premium selling. That's less than the benchmark. That's less than the benchmark, so by about 6.5% or so. So we have a selling edge that's negative. Statistically, it's more likely than usual, okay, if history plays out, that today's bar or Friday's bar, the current market condition, will end up being an unfavorable one for selling out of the money put premium. All right, now, so you might be wondering, well, you know, it's negative, there's a negative edge on selling puts, but yet to go market neutral, butterflies and condors, we have a positive edge. What's going on here? So let's go to the market likelihood report. Okay, and what we do here is we just look at the benchmark rates of change that have occurred for every 5-day, 10-day, and 15-day rate of change. So what you'll see here is out of the over 4,700 closes since January of 2000, on average, the market goes up roughly 0.1% every 5 days. So you could take any close, look at the close 5 days later, and it's going to, on average, be higher by about 0.1%. Now, that's since January of 2000. And we've had a bull market since then, of course. There's been bearish seasons, of course, a couple big ones. However, on average, it goes up 0.1% or so. Every 2 weeks, it goes up about 0.1%, 0.2. Every 3 weeks, it's at 0.3. So that's our benchmark rate of change. When we go to our 43 occurrences, we see that on average, we have, for those 43, if you took up the 5-day rate of change for all 43 occurrences moving forward, you have a positive upward move of 0.17, okay? And then what's the significance of that? That's more than 0.10, and that works out to be just about 8% of a standard deviation of the upside. That's how significant that is. That's not very much. That's what the z-score is here. We take the change. In this case, it's an extra 0.06 of a percent, divide by the standard deviation there, and you get a z-score that's not even 10% of a standard 10% of a standard deviation of the upside. Not very much. Now on the 10-day z-score is actually 14% of a standard deviation to the downside, and the 3-week score is about 1/5 of a standard deviation to the downside. Okay, so kind of a mixed bag here. Now what we can do is carve up the price action so that of our sample of 43, there were 27 times where the market went above that outside bar's high. Now when we look at those 27, we can see now that there's quite the bullish bias here, with a z-score of almost a full standard deviation to the upside, 14% of a standard deviation, and 20% of a standard deviation to the upside when it goes above Friday's high, in this case, that outside bar's high. If it goes below the low of that outside bar, that occurred 14 times, and there you have negative z-scores that are between 70% of a standard deviation to the downside and 1.5 standard deviations to the downside. Now, that's only 1/3 of those 43. The other 2/3, the market went above it. So when you put it all together, it's kind of a mixed bag, but suffice to say, watch and see if Friday's high is taken out on the upside or if Friday's low is exceeded, because that will kind of tip the hat of the market in terms of direction. Finally, let's go to volatility. On average, the market is experiencing a realized volatility of roughly 15.5 to 16%. 15.5 to 16%. Our market condition generates a volatility level of the market annualized at roughly something between, say, 13.5 to 14.5%, right around there. That's lower than the actual benchmark, the behavior of the market. All right, so so just understand that it's likely that the market will be less volatile than normal, given what we've got here. So What we can do now is look at the VIX at 12.07. That's the 30-day VIX, which is lower than what we expect the realized to be. So that's a disadvantage to the premium sellers. Okay, just keep that in mind. Right now, the VIX is kind of lower than what we expect the realized volatility to be. So that's kind of a yellow flag in my opinion. You were just not getting the premium relative to what the likely realized volatility is to be. In terms of the 9-day, it's down there underneath 10%. So clearly a bullish bias coming from the structure of the VIX. Short-term 9-day VIX is far less than what the 30-day VIX is at. Okay, super. I hope this has been helpful information. Again, we're Discover Options. If you have any questions or if you want to explore one-on-one mentoring with us, we can take you as far as you want to go in premium selling in terms of direction or non-directional strategies. And we have a great group of mentors with us. We've been doing this a long time. So give us a call or shoot us an email, 847-816-6610. Thanks a lot. We'll talk to you later. Have a great week. Bye-bye.